In early 2026, Amazon CEO Andy Jassy shared a significant internal projection. He stated that if Amazon's custom chip division sold its products to external buyers at market rates, it would be a top 3 global data center chip company with a $50 billion annualized run rate. This reveals a foundational shift in how Amazon is driving efficiencies through AI, starting not with software, but at the level of the silicon itself. For an e-commerce and cloud company to quietly build a semiconductor operation of this scale alters the established power dynamics of the global AI boom. The current AI market faces a severe hardware bottleneck, with Nvidia controlling an estimated 70 to 75% of all data center AI chips. For hyperscalers like AWS, relying on a single vendor is a strategic risk. Nvidia's hardware carries a high premium, and persistent supply constraints make it difficult for cloud providers to meet surging customer demand. The solution is moving from general-purpose GPUs towards ASICs. While a standard GPU handles varied tasks like graphics and logic, an ASIC executes a single compute workload with maximum efficiency. Amazon partnered with Marvell to develop ASICs optimized strictly for raw AI processing. By designing this silicon from the ground up, Amazon can control its own cost structure, protecting AWS profit margins from the markups of a hardware monopoly. Amazon's hardware has evolved rapidly since the 2021 launch of Trainium. The current Trainium 2 generation claims a 30% price-performance advantage over comparable GPUs on the market. The upcoming Trainium 3 generation is built on a 3-nanometer process to deliver another 30 to 40% performance leap, and demand is already high enough that Trainium 4 is heavily pre-reserved. This chart shows the financial scale of Amazon's custom silicon portfolio, including Trainium, Graviton, and Nitro. This division is now generating over a $20 billion annualized run rate, growing at 40% quarter over quarter. These figures prove that custom silicon is no longer a localized R&D project. It has become a central structural profit engine for the company. Amazon secured the future of this business with a $225 billion backlog in multi-year customer commitments. Much of that is driven by a 10-year, $100 billion deal with Anthropic. The agreement requires 5 gigawatts of capacity and will utilize 500,000 Trainium 2 chips for a single compute cluster known as Project Rainier. OpenAI has also committed to taking 2 gigawatts of Trainium capacity as part of Amazon's recent $50 billion investment into the lab. In a major shift for 2026, Amazon is moving beyond internal AWS workloads and beginning to sell Trainium chips directly to external customers. By securing these long-term contracts and entering the merchant silicon market, Amazon now competes directly with the same chip makers it once relied on for its entire fleet. Despite Amazon's progress, Nvidia maintains a powerful moat. Their 75% market share is anchored by the CUDA software ecosystem, which creates high switching costs for developers who are already trained on Nvidia's platform. Amazon also faces a critical supply chain vulnerability. It is entirely dependent on TSMC as its sole manufacturing partner for these high-end chips. Scaling Trainium production to meet gigawatt-level demand involves significant execution risk. The physical manufacturing of these components is technically difficult and highly sensitive to disruption. There is also the risk of customer concentration. The vast majority of that $225 billion backlog is tied to 2 AI labs, Anthropic and OpenAI, which are themselves heavily dependent on venture capital and big tech subsidies. If the broader AI market cools and capital expenditures decrease, these guaranteed megadeals could shift from reliable assets into significant liabilities. The bear case suggests that Amazon is overextended, concentrating its future revenue on a few subsidized startups while fighting an uphill battle against Nvidia's software dominance. The bull case views Trainium as a high-margin asset, breaking Nvidia's pricing power and creating a lucrative revenue stream outside traditional cloud services. This aligns with Jeff Bezos's recent assessment that custom silicon is becoming Amazon's next durable pillar, joining the ranks of Marketplace, Prime, and AWS. Whether this is a strategic masterstroke or a bubble-era risk, the numbers are clear. Amazon's chip production and revenue have reached a scale that rivals the world's most established semiconductor firms.